So, welcome to an amazing episode of Founders Across Borders, wherein we feature researchers, founders, investors from around the world with their stories and the information and impact that they've created for so many of us in the global space. And today we've been joined by one of the most amazing people I've known, Dr. Lawrence White. He has been with New York University for more than 45 years and has worked in financial regulation, antitrust, network industries, international banking, microeconomics, and whatnot. So I think it's such a pleasure to have you with us, wherein almost more than 4 decades of experience into markets, into economics, into how do we apply the things that we learn when it comes to financial regulations. So, thank you so much for joining this episode with me today.
Well, thank you for the opportunity. And just for the record, I am completing my 50th year here at the New York University Stern School of Business. So here, here I am. Um, there are lots of, we're going to talk about finance, and there's lots of aspects to finance. Do you want to think about stock markets and securities? Do you want to think about bond markets? Do you want to think about options and futures? That's often just summarized as the capital markets. My experience, my research has mostly focused on banks and banking. Um, and I I happen to like this. I think it's interesting. And in many ways, banks and banking, on the one hand, you think, boring. On the other hand, it is and continues to be the essential infrastructure of any modern economy. Banks, at their fundamentals, they take in deposits and they make loans. Now, that sounds very simple. In fact, it can be a lot more complex, and banks do other things besides just taking in deposits and making loans. But when you really boil it down, that's what banks do. They take in deposits, they make loans. And the structure I've just described is inherently fragile because depositors expect, under most circumstances, to be able to withdraw their money at any time.
Hmm.
But the deposits are providing the funding for these loans, which are almost always longer term and less liquid. So they can't be liquefied, they can't be called in or otherwise, um, liquefied into cash or some other resource that could be used to pay those depositors who want their money now. They don't want to wait, they want it now. And so that the structure of banking, and this has been true from the beginning of banking, going back centuries,
Right.
has this inherent fragility to it that can lead to what's called runs, where the depositors get nervous. They may not think, they may not at the beginning think there's a problem,
Yeah.
but if they start to believe other people think it's a problem,
Right.
and the other people rush to the bank and want to pull their money out, the first person who otherwise didn't say, maybe there is a problem. I better get there first.
Yeah.
And so you have a race to the bank. We saw this most recently 3 years ago at
Hmm.
Silicon Valley Bank. In fact, we're
Oh.
coming up very close to the 3-year anniversary. It was in March of 2023. Um, but the Bank experience, it was just a you know updated version of what happened in 2008
Hmm.
with investment banks. Um, and that was an updated version of what had happened with the savings and loan debacle of the 1980s, which was a updated version of what happened in the United States between 1929 and 1933, when thousands of banks had to be shut down because partly they had problems with the loans that they had made, but partly they had these kinds of um, crowd herding. The people see, at that in the 19 early 1930s, it wasn't a matter of um, internet type communication, obviously. It was literally people lining up outside their bank, waiting to get in, waiting to withdraw their money, and other people seeing that there was this line, oh, I better go to my bank and I better pull. And so you get contagion. All right. So that's the general phenomenon. That's why banks are fragile,
Yeah.
why we have extensive regulation of banks that, alas, in something like the Silicon Valley Bank debacle, the investment bank difficulties of 2008, the
Yeah.
savings and loan debacle, etc., we didn't have good enough regulation. But the essential fragility says that banks first need to be careful in the kinds of loans they make,
Hmm.
because if their loans start to go bad, then they're not going to have enough resources to pay back their depositors. And if depositors start to get nervous, we get the runs problem.
Yeah.
Um, in addition, there is just this inherent time dimension where the deposit obligations are relatively short term. The uh, investment loan um, assets of the firm are always going to be longer term. And if they get to be too long, then there's the problem of interest rate risk. When interest rates go up, the value of long term bonds, long term loans go down. That's macroeconomics, economics 101.
Yeah.
That's what did in the Silicon Valley Bank and a few other banks at that time. And so there needs to be restrictions on what banks can do, the quality of their loans, just the interest rate risk that they can take, and they need to have enough capital, what
Right.
the rest of the financial world would call net worth. In the banking world, it's called capital, but it, it, as a very good first approximation,
Yeah.
think net worth. Um, and net worth is, in essence, a buffer that protects depositors and other liability holders against losses on the asset side of the bank balance sheet. And so we need regulation to, again, make sure the bank is making not wild and crazy loans, but reasonable. There's never going to be risk free, but taking reasonable risks and dealing with interest rate issues in a reasonable fashion, and having enough net worth. Alas, um, when bank regulation is not doing those things effectively,
Right.
as was true for Silicon Valley Bank, as was true in 2008, et cetera, et cetera. That's when we run into difficulties. And much of my research, my writing has been in describing these situations, trying to break it down into, I hope, reasonably understandable terms, and suggesting improvements in policy. So that's a little, a long answer to your question, but that's what I do.
Well, I mean, it has been interesting to hear the point of views and how you've implemented that system specifically for the Silicon Valley Bank. And when you understand the banking norms, I would love to understand one specific thing with, in addition to this, since you've helped them design the right policy, the right framework, how have the recent developments like the digital currencies, fintech platforms, cryptocurrencies challenged or will be challenging the traditional regulatory frameworks that are currently exercised by the banks? So, what is the transformation that you're seeing?
You're asking a very good question. And the way I think about, you know, I'm, I'm not a big fan of things crypto. It's often hard to find good use cases for crypto, but I sort of have to acknowledge there's a lot, a lot of people who do find, for whatever reason, are finding crypto useful. And so I've got to sort of learn to live with that idea.
Right,
Um, I think of crypto as um, another form of currency, liquid payment, although a lot of it gets tied to things like the dollar. So at the end of the day, it's crypto, Bitcoin that's getting valued in terms of dollars. It's not dollars that are getting valued in terms of crypto. Dollars are the base. Crypto, or Bitcoin, is the sort of addition.
right,
Um,
right,
to the
absolutely.
to the extent that we've got things, crypto institutions that end up looking like a bank,
Hmm.
in the sense that this institution is taking in funds from investors, turning around and investing those funds in something.
Correct.
And if the investors are thinking about their investments the way depositors in a traditional bank think about their deposits, that this is a safe instrument and withdrawable at any time, then if it looks like a duck, if it quacks like a duck, it's got to be treated like a duck. And so,
Correct.
um, if we don't have bank like regulation
Right.
for these new institutions that look like a bank, quack like a bank, we could run into the same kinds of difficulties that 100 years ago, 1929, uh, we ran into. Um, I worry, as you probably know, the Genius Act
Yeah.
has encouraged the formation of crypto based institutions. I worry, I'm not trying to shut them down, but I
Hmm.
worry that without thinking in bank like terms,
Hmm.
we will run into the same kind of problems. Not tomorrow, not the day after tomorrow, but a couple of years from now. I worry that the same kinds of problems that befell the banking industry up to the creation of deposit insurance in 19 federal deposit insurance in 1933. And again, we've had some relapses occasionally, but for the most part, the banking system has been far more stable since 1933 than before. I worry if we don't think in bank like public policy isn't thinking in bank like terms about these new institutions, we will relive the experience of before 1929.
I mean, now if I think about it, it is more instilling that sense of fear as well because, I mean, that was not the great time when it comes to banking or like the space that we had been, and specifically even for the world, it was one of the times when we were dealing with an economical crisis globally. So when it comes to these systems that like of course we do not want to go back to like almost 90 years back or 95 years back to what happened. What do you think that if you as a person could redesign the financial regulation from scratch, what
Ooh,
would the
ooh.
core principles of that be?
You're asking a very good and fundamental question. Um, you know, one fundamental principle should be, you know, because we're going to need governmental regulation. We're going to need it because there are things, markets are very good at
Yeah.
some things. I'm a big believer in markets,
Mm-hmm.
but when it comes to things like uh, what economists have called asymmetric information, or things like spillover effects, markets are not very good at dealing with those. And what we then, if they're not very serious, then you sort of grit your teeth and you say, uh, the potential dangers from government stepping in, or of government getting it wrong, government stifling things. Uh, the dangers are there. So that's why you want to reserve government regulation for situations where those information problems are substantial, not trivial or tiny, where those spillover effects are substantial, not trivial or tiny.
Hmm.
So that's the first thing. The second is what many economists
Yeah.
have called for, which is if you're going to have regulation, do it by function, not by just nomenclature. So,
Hmm.
back to my if it looks like a duck, if it quacks like a duck, treat it like a duck
Hmm.
metaphor. If you have an institution that is issuing short term liabilities, and it doesn't matter if you call them deposits or you call them um, um, tokens,
Hmm.
or you call them XYZ, if they are short term and the holders expect to be able to withdraw them at short notice,
Hmm.
then you have the kind of fragility that I described at the very beginning, where um, the the runs problem, which is a contagion problem, which is a spillover effect and information asymmetric information problem. Any institution that issues large quantities of these short-term runnable liabilities should be treated the same way, and basically the same way that sensible bank regulation should be structured. The regulator should be concerned about the safety and soundness of the bank. Is it, you know, making reasonable loans, not wild and crazy loans? Is it dealing with interest rate risk? Does it have enough capital, enough net worth to be able to cover some losses? If it looks like a duck, if it quacks like a duck, you got to treat it like a duck. That would be a fundamental principle for financial regulation in this area. You know, you want to talk about the stock market, then we're talking about a whole different type of financial activity
Yeah.
where you worry about um, um, you know, information flows. Do you What obligation do you think the government should have toward investors in securities that are traded on stock exchanges? It's a completely different set of questions, and that of course extends to options and futures as well, than this issue of if you've got a depository institution or something that looks and has very similar characteristics to the way we think of a depository institution, um, dealing with it. So one shouldn't, again, one can talk about financial regulation, and you and I could spend, no, 5.5 days talking about financial
Oh, yeah.
regulation.
Yeah, very true.
We don't have that time. We don't want to have that time. Um, you've got to sort of categorize them, treat one problem at a time.
Got it. That makes a lot of sense, treating one problem at a time. And I'm very curious to know, like you've spent almost 5 decades of your life in with numbers, and numbers are what makes you wealth. So, and since we're talking about a lot of people, those who come to the United States with those, or at least want to have their company's subsidiary out here as well, so that it sets them a foot for a better financial future, like with different ways. How is it possible, if you have an understanding of how the banking and the regulations work, one can think of having their first $1 million in at least 2 years?
Woo! 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 Um, no, I'm going to make what is, doesn't really address your question, and um, you know there used to be a bad joke about the airline industry.
Hmm.
The way to make a small fortune is, is to start with a large fortune and invest it in the airline industry.
Yeah.
Okay, that doesn't answer your question. I look. Um, I in the finance world, there is the idea of efficient markets that basically the collection of information gets processed in markets, and unless you know something that the rest of the market doesn't know, and you can act on that knowledge, sorry, you're not going to be able to make that $1 million in 2 years. I'm a believer in saving substantial fractions of your income, investing in a diversified portfolio, taking what that market return on that diversified, of course, low transactions costs, diversified portfolio, and living with the market. I don't have good information that the rest of the market doesn't have. Um, so I can't act on any insight, not even insight, just special information. I don't have it. And I don't even know. There may be people who do have it, but I don't know who they are. And so, again, there may be such people, but unless I know who they are, I'm not willing to trust somebody who says, "Oh, I can make you $1 million in 2 years." Um, Maybe that's so, but it's talk is cheap. It's easy for somebody to make those claims, and on average, that can't be true. On average, not everybody can turn whatever they have now into $1 million within 2 years. That's not the way the financial markets work. And so I'm just, you know, I think in very traditional uh, terms. I'll use an American football metaphor. I'm doing the blocking and the tackling,
Right.
doing the fundamentals, and I don't. I just don't have the special information, either myself or know who does have the special information to be able to do anything else.
So, with that being said, and I really appreciate the transparency in this answer, is because absolutely talk is cheap, and when it comes to execution, you need to put a lot of statistics, numbers, and the current funding you have. I mean, I don't think you can just have zero and then think of the first $1 million. So, you've, as a person, moved between both academia and public policy, from the antitrust division of the DOJ to the Federal Home Loan Bank Board. And
Correct.
how has those experiences reshaped your view of economic regulation? Or to keep it more simple, one concept that you feel is like a great concept that you learned that you'd love to share?
Good. Those are good questions. Um, in addition to the two government positions, short term, that I had, a third, I was on the senior staff of the President's Council of Economic Advisors. I was a
Hmm.
senior staff economist during the 1978-79 time period. So I've had three opportunities to work in the United States government. Each time I returned to New York University, I learned a lot. Uh, I think I came back each time a better professor, better able to talk to my students, to uh, provide insights to my students, and of course, to write about these things in books, in articles, in op-ed pieces, in filings with government agencies. To get back to your question, one of the things I really, all three times, came away with was how impressed I was with the high quality of the lawyers, the economists, the other men and women who were staffing medium to high level positions in the United States government. It's, you know, it was a pleasure, it was an honor to be working with these people. I could learn from them. They could learn from me. They, they were goodwill individuals. Just the quality was just so good. As a sidebar to this, I worry uh, about the recent events of the last year and whether that quality is, I think it has already deteriorated. I fear it's going to deteriorate more as people just leave and it's hard to replace them. And it's hard to assure someone nowadays that, you decide to enter government service, it's something honorable, it's going to be, you'll be well respected, you'll be reasonably paid. It just worry the quality. One one needs good quality men and women in important positions in any government, whether it's federal, whether it's state, whether it's local. Um, these are important functions, and you want good quality people in them, and you don't get good quality people if you dump on them on a regular basis. You the the leadership dumps on them. The leadership disrespects them. The leadership calls them bad names. That's not the way you attract good people into these positions. So, all right, coming back to your basic point, what I learned is you need not only good policies, you need good people to carry out those policies, and so and um, again, the fundamental policies of government ought to be addressing the things that markets are have more difficulty addressing, whether it is the exercise of market power by monopolies, oligopolies, monopsonies, which is buying power rather than selling power, um, information problems, uh, spillover problems. There's legitimate role for government for good policies, and you want good people. And there were again, all three of my experiences. I was so impressed with the quality of the people with whom I was working. It was a real treasure. I worry about it today.
Thank you for being very honest about this and like given a true picture of how it looks like or it might seem like in the coming future based on how things are changing so dynamically out there. Which also brings us to one segment that we do here, 90 seconds to teach me something. So, if I give you right now 90 seconds on the spot to teach me something, what would you like to teach?
Oh, wow. I would like to teach you that the best way to deal with something like global warming is to have a carbon tax that we have a spillover effect. We have what economists slightly technically term an externality. And by having a tax on carbon, carbon is the basic problem with global warming. And you put a tax on emissions of carbon into the atmosphere, you can then channel market forces into finding ways to economize, to cut back on carbon emissions. Again, all the power of the ingenuity of markets will then be focused on let's figure out how to reduce the carbon that we release so we will reduce our taxes. In addition, to the extent that there is still carbon coming out, that will generate revenue for government, which means we will not need to rely as much on other kinds of taxes, whether it's income taxes or sales taxes or securities taxes or some kind of other tax which has distortionary consequences. Here, a carbon tax has beneficial consequences, cutting back on the externality, you know, getting markets focused on how do we do this best, how do we do this most efficiently, and in the process, we raise some revenue for the government as well. Maybe I took more than 90 seconds, but I tried to get it right there.
No, I think that thank you so much for actually giving that perspective as well, because I did not think of it at all. So I think I have some food for thought and some great stuff to research as well in depth, because it did pique my curiosity as well. So thank you for this.
Always happy to help. Always happy to help.
And with this, we come to another segment. It's called Seven Questions to Fame. So once you're ready, I'm going to throw seven rapid fire questions along your way, and feel free to be precise or quirky or quick with the answers.
Woof, woof. Okay. All right.
Okay.
Fire away.
Okay. So in your books and papers, you have analyzed different financial regulations and systemic risks based on how AI is shaping up different things, and it's been a talk out in the world now. What lessons from the past financial crisis still remain the most relevant today?
Um, the basic problem of um, whether it's individuals or more likely financial institutions that issue short term liabilities, think of it as deposits, and that make bad investments. That's something that, if it's on a widespread basis, or can become on a widespread basis because of contagion. Maybe AI will help us deal with that better, maybe. Maybe AI will encourage more of this bad type of behavior. We're just going to have to see how things come out. I think it's really important to remember, even something like gunpowder, okay? Gunpowder, wonderful invention, allowed us to, build, incredible hydroelectric dams, among other things, explosives, but also has the downside that it can be used for ammunition and used for very destructive purposes. A lot of innovations end up being two sided. You just have to be aware of that.
Understood. I think that is fruitful to have this perspective as well, as to this is something that's going to be relevant today and for the foreseeable future as well. So I think everyone should be thinking on these lines. And the next question goes like, one major insight that you feel from this year to the next 2 years, AI will be reshaping completely, whether that be research or whether that be how different businesses would view the banking system now?
Um, I, I'm not sure. All right, please ask the question again because I'm not sure I really got the central.
Yeah, sure.
I,
So I'll rephrase it. How do you think AI would reshape the way the current industry has been, specifically for businesses who view the banking ecosystem now?
okay. All right. Good. All right. Let me start by saying I have a perhaps way too simple image or understanding of AI, and you know, I understand what I'm about to say is way too simple. But one way of thinking about AI is ah, it's like using spell check in a word processing or email system. Or it's like uh, talking with, calling up your airline or your bank, and, you're not talking to a person, you're talking to a machine that has the understanding of what you've said, what you're asking for, can give you sometimes pretty good advice, or response, just as spell check can sometimes really do good things. One could imagine a more sophisticated spell check that rewrites the paragraph rather than just corrects the grammatical or spelling errors.
Hmm.
Uh, and so that's again way too simple. I understand that, but that's sort of one way to understand AI. AI will be able to take information and offer just the way that voice when you call the airline offers you a response.
Hmm.
Take information, offer a response. The response, in terms of a business dealing with a bank, is going to be a whole lot more sophisticated. Um,
Understood.
I don't think AI is going to make a big difference in this kind of area. Now, if I were a computer programmer and I'm seeing examples where AI has taken over coding,
Hmm. Right.
I might be a lot more worried. Um, but I look. I'm in the educational business. I've been seeing people tell me for 20 years that, oh, everything's going to go digital, everything's going to be either remote, or that the person in a classroom is history. Okay. First, the irony of all of these meetings and conferences where this was being said, it was all being done in person. It wasn't being done through remote or digital. It was all being done in person. And second, um, there's no question there are some things that can be relegated to more digital and more mechanical things. But, and obviously, I'm an interested party when I say these things. I, I'm a big believer. I'm at a university, New York University, a big believer that the the in person, uh, you know, I will grant you, you and I are having this conversation not in person. We're having it electronically, and that's wonderful.
But
And
we are going to meet in person as well. So,
well,
Yeah,
Okay. Okay. I'm a big believer. New York City is built on in person, you know,
absolutely.
in person.
True.
And whether it, so uh, I'm an optimist on this. I understand people who are less optimistic than I am, but I'm an optimist.
Thank you for this. And that's very true. I mean, to just add on before I move on to the next question, since I also develop communities and experiences, I felt that the in person experiences that you develop shape so much out there for people than any virtual experience can. I mean, they are impactful, but any in person, because then I think even scientifically, the five senses that you have activates, and
Yep.
that deepens the memory and the experience altogether. That's the reason in-person experiences are expensive. People prefer, like, I had to meet Mr. Peter. He's the admissions dean at MIT. Before me, like, hopping on any virtual conversation, he preferred to meet in person at
Good
Tate
for him.
Bakery.
Good for him. Good for him.
And just because, people want to feel that now, am I speaking to a real person out there? Like, is this a real person? It's not a bot. And I think as long as humans are going to be here, a huge percentage would still prefer in person connections. So, yeah, I
I agree. Uh, you and I we're in the same. We're reading out of the same book, or whatever metaphor is.
right. That's
Right.
pretty, yeah.
On
Moving
the
on.
same page. On the same
On the
page.
same page, yeah. And moving to the next question, looking back on your career out there, what do you consider your most meaningful contribution to economics or public policy is late?
You're asking again good questions. Um, in a lot of my research, my public policy involvement, and the writing that has followed involved antitrust, involved bank regulation.
Yeah,
In the antitrust area, um, I, along with a few other employees at the antitrust division of the U.S. Department of Justice, contributed to a better understanding of how to analyze mergers when they are likely to be anti competitive, when they are perfectly okay and uh, don't pose competitive problems. So, making a contribution to antitrust analysis in the area of mergers, I consider one important contribution. And then just, all right, I haven't succeeded, but I keep on writing, pushing as hard as I know how, that we need for financial institutions, especially for banks and bank like institutions, we need to change our fundamental accounting system. The basic accounting system, it's called Generally Accepted Accounting Principles, GAAP, is a backward looking um, um, original transaction, original value concept. There are understandable reasons why accountants adopted that system and feel most comfortable with it, but especially for banks, but even for many other types of institutions, having current values, market value accounting, what the accounting world calls fair value accounting. Anytime you hear an accountant talk about fair value accounting, he or she is talking about mark to market, current market value accounting. That's the way the certainly the financial world, especially for banks, ought to be focused. Alas, I've been talking about this for over 30 years, coming on 40 years. Uh, we make a little bit of progress every once in a while, but not nearly enough progress. Better accounting, which means market value accounting.
Got it.
Very fundamental.
So, actually, my next question is on the lines of the answer that you gave. What's one economic concept that you feel most people understood?
That they do understand.
That, like, they should put efforts to understand.
Oh, that, or sorry. Let's, that I wish they did, but too many do not,
Yes.
or I applaud that they do.
You
What,
wish they did, but
I,
they do not.
ah, okay. Um, in the microeconomics world where I live, and economics more generally, the idea of incremental things at the margin. Uh, I teach microeconomics to undergraduates, to MBA students, to PhD students, and the idea of marginal cost, marginal revenue, marginal benefit. The marginal concept comes up again and again and again, and I wish more people were attuned to this idea that it's things at the margin that is going to be important for decisions. Related to that, I can't not also add the idea of opportunity cost, that one ought to be thinking about alternatives, the foregone opportunities, the opportunity cost of any action that one is taking. They are very related concepts.
Now, I'm recalling my days of when I used to study economics in the classroom.
Ah,
And like, I remember how my professor used to emphasize on these topics and be like, you need to understand, and not just like, since it was a business major as well, just to like understand the business, but it's like the basic of how economies operate. So, one thing that I really appreciate personally, my own perspective about finance and economics as a subject is that it just not gives you an understanding of having a mindset of, go to a company, work, and get out, but it gives you a broader picture of how you can envision that as an institution and how that institution is supposed to grow. So I love that perspective that comes from these fundamental concepts.
absolutely, absolutely. And you know, sorry, I'll throw in a third one. Whenever I teach game theory, anybody who teaches game theory
Yeah.
will always use the expression think ahead and reason back. The formal term for this that the game theory guys
Yeah.
use is the word backward induction, but
Hmm.
it's basically, and most of us use this idea every day of our lives. We say, oh, I've got to be at my office by 8:30 this morning,
Yeah.
so I need to get out of the subway station at 20 minutes past 8 o'clock, which means I need to get on the subway at my stop at 10 minutes of 8, but there might be some friction, so I need to leave myself a little bit of extra time. All of these things are involved with looking ahead and reasoning back. We do it, but we need to do it more fundamentally in other parts of our lives rather than just I have to be at my office at 8:30 this morning.
Oh yeah, absolutely. That is.
Backward induction. And I just try to do that over and over again
Uh,
in my personal life and beyond just I have to be in my office at 8:30.
Thank you for sharing this. I really appreciate the honesty and you're very right. I think you think through and then it's like reverse engineering as well, looking
Exactly
at
right.
the terms.
Exactly. Nice, good metaphor, good use of that metaphor. Absolutely. Absolutely.
Right, right. And
Yeah.
the last question to this question around would be what book you recommend your students, undergraduate, postgraduate, alumni, or anyone you come across in the business field, or like your target group of audience should read once in their lifetime.
Oh man. Oh man. Ah. Well, you have to understand, I'm not an avid book reader. I read lots of articles. I read hard copy of the New York Times and the Wall Street Journal every day. So I'm filled with print. It's just the print is mostly not coming from books. Um, you know, read I'm not a big science fiction guy, but early on, I haven't had an older brother. He suggested I read some of Ray Bradbury's books and stories. One of the early ones, The Martian Chronicles. As it turns out, Bradbury, and he wrote the wonderful novel Fahrenheit 451. Um, he wrote some magnificent short stories as well. Uh, read Ray Bradbury.
Oh, I think I'm gonna take some time and go and read about him as well because I am for the first time introduced to the name and the work. So it is a good addition to my checklist as well. So
There you
thank
go.
you for that. And with this, we come to the last segment. It's called the deep dive. I've had an amazing conversation, and I genuinely wish we had hours and hours to talk about different things. However, in this deep dive, if you feel that we missed on something or some topic that you feel is relevant and we should specifically emphasize on that, we could talk about that.
No, we've had a good hour. I've said lots of things. I've gotten, I hope, some important points across. You ask very good questions. I'm, of course, stroking you a little bit there verbally. But no, this has been a good conversation, and I really appreciate it.
Thank you so much for this. I really appreciate your time. And before we hop off, what's one last piece of advice that you would give either to a student or on a deeper level, maybe that younger kid in you or that 25-year-old version of your own self?
All right. In fact, I was just talking to four students at 12 o'clock noon today, who I will be mentoring in at great detail in June at a conference out in Denver. Think of ways that you can provide, I'm going to call it positive spillover effects, positive externalities for the people around you. I will give you two, they are trivial, but they are symbolic. Okay. Here I am in my office. I have some wonderful colleagues. I love them. I really love being with them. We, of course, have a photocopy machine. Okay. I have now made it my absolute rule. Whenever I go, it's a combination printer and photocopy machine. Whenever I go to print something out, I put more paper in the machine than I take out. Okay? Just simple rule. Put more anytime every time I go. I put more paper in the machine than I take out. Okay? I'm providing a benefit to the people around me. They are less likely to run out of paper, etc. We have a little Keurig coffee machine, and I pull coffee out of the Keurig. Every time I go to make a cup of coffee, I put more water in the machine than I take out. Provide positive spillovers, positive, make life better for the people around you. Those are small, trivial ways of doing it. You can find now. I'm not suggesting you should go out on the New York City street and sweep
Yeah.
up every single piece of trash that you will never. That's a lovely goal, but it ain't gonna happen. But hey, I can put more paper in the copy machine than I take out. And I think of that as a symbol. I try to think of other ways. The people around me, the people I care about, and sometimes even people I don't know, but who are going to benefit because I've been a little more careful. Uh, that makes me feel good.
Wow. Thank you so much. And it is beautiful to look at the point that provide more, and if you can, and just little ways, not like, hey, I'm going to invest $1 million and change the world, but little acts of providing more changes things. And that's what made me remind of what my dad always tells me, that it's the way you do one thing is the way you do 100 other things. So
You
if
you
you
have
are
a
being
wise father. You have a wise father. A wise father.
Thank you. So I think the way we do things out there in the world shapes how we look at bigger things in life. So thank you for somehow reiterating that for me as well. And I really am so grateful for this conversation with you today.
Well, thank you. I'm really glad we had this opportunity. Really glad. Thank you.